reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee. Good morning, everyone. Thank you so much for being here today for our special edition of the Meet Me for Coffee podcast. We have an awesome panel conversation happening today. This is history in the making for the Meet Me for Coffee podcast. The first time I've had not 4, but 5 guests on at one time. And so we're going to see if we can all get our thoughts shared in about 1 hour here. So thanks for making the time to join. If you're listening back, thank you also for listening back and for being here. Just a reminder that we love questions from the audience. So if you guys haven't got your questions out yet, you can put them in the comment at any time as you think of them throughout the show. Put them in the comments, and I'm going to be monitoring those, and we're going to get to them throughout the panel today. So we do these podcasts to help others learn, to get their questions answered. And so please don't be shy. Please feel free to ask questions. Also, we'd love to know you're here today. So if you're listening, go ahead and pop in the comments and just let us know who you are, where you're listening in from, and maybe what you have going on this morning or this week. I don't know. We just want to know who's here and what you guys are thinking. I have no major announcements other than it is not too early to be planning for Manifest, the conference that happens every year in Las Vegas in February. So yes, that is in 2027. Yes, it's already planning. Yes, the first rate increase already happened. So you can still save the most money possible now if you register today. I do have a $200 discount code. Will you guys just shoot me a message? I'll get that to you directly. Ask me any questions you have about the show, if anything's going to be different this year, who should go, who should attend. I love getting those questions. Happy to talk to you about it. So send me a message on LinkedIn and I'll get you guys hooked up with that discount code, and we can all plan to hang out in Las Vegas in February. Okay. That's all I have. Without further ado, I want to go ahead and start bringing on all of today's guests. I'm going to let them introduce themselves today. And so give us just a minute to get this awesome panel in here. All right. That's everyone. Hi, guys. How are we doing?
Morning. Great.
Great.
All super excited to have you all here. And to help with introductions, I'm just going to go around the circle as I see you guys on my screen. We're going to start with Chris, and then that'll go to Ken. And go from there. So good morning, Chris. How are you doing?
Good morning, Samantha. Good to be back. Good to see you, gentlemen. Sorry I missed you the last installment back in January, but we finally have some fireworks to talk about. In the last few of these, it's been a fairly downbeat market. Wasn't a lot going on. A lot of range-bound forecast at flat to plus 3 or 4%, but I suspect that will not be the case this time. So we'll be back. Chris Pickett, Chief Commercial Officer at Flock Freight. Been at Flock for 5 years as of today. What Flock does is really the market scaling the first of its kind share truckload freight offering, basically truckload freight service, same truck, same driver, no terminal consolidation, only pay for the space you need. So when spot rates are going to the moon, a great place to look for budget relief is looking to see where your trucks aren't full and finding a way not to pay for inflated capacity costs you don't need. In the meantime, also publish a monthly market newsletter under Pickett Research called the Pickett Line. We're now in our 6th year of continuous monthly publication. It's been a wild 6 years. And before that, spent 14 years scaling up Coyote Logistics. So nice to see everybody.
Yeah, thank you, Chris. Did you say today, as in like today's your work anniversary for 5
years? It is, yeah.
Oh, congratulations. Happy work anniversary. All right, moving over to Ken.
Hey everyone, I'm Ken Adamo. I am Chief Strategy Officer at Ease Logistics. I have been here for a whopping, I think, 6 weeks. I have impeccable timing when changing career spots. I joined DAT as Chief of Analytics about 2 months before COVID, and I joined here about 5 days before the Montgomery Supreme Court decision. So watch out when I change careers next, because it's probably going to start raining locusts or frogs or something. I don't know exactly what the next thing is in store.
Awesome. Thank you, Ken. Jason, you're next.
Hi, everybody. Jason Miller, Eli Bro Professor of Supply Chain Management here at Michigan State University. Most of my specialty has been motor carrier safety. Funny enough, I think more industry interest in that than the last 14 years I've been studying that, thanks to the Montgomery ruling. And then also study a lot of things at the intersection of supply chain management and economics.
Aaron?
Sure. So I'm Aaron Terrazas. I was Director of Economic Research at Convoy. Have spent my career as a professional economist at a variety of places at Zillow. I was Chief Economist at Glassdoor, started the Treasury Department. Right now, I do independent consulting, and I also teach at the University of Washington. Glad to be back.
Awesome. And David?
Hello there, David Spencer. I serve as the Vice President of Market Intelligence at Arrive Logistics. Coming up on almost 9 years here at Arrive. So, I've been here since the early days, seen some pretty good fun growth here at this organization. Been in transportation, brokerage side of things since 2011. So, been through a couple market cycles, and really that's where my job is focused today, on understanding what's going on in the freight market, how that affects our business and those that we work with, and helping drive discussions around how we operationalize some strategy to navigate those conditions.
Awesome. I was just thinking, it's been at least a few years, I think, since I connected with a lot of you for the first time. It's been really fun to watch all of your guys' company growths and milestones and movements. So congratulations to each of you guys on your respective successes. It's been fun for those of us watching and following along and learning from you guys. So thanks for taking the time today. Okay, first things first. All of us on this panel were on the panel and or emailed me, Chris, and shared some thoughts back in December or January when we ran our last market update panel. And so I want to start this show with a quick reflection for the purpose of saying, here's what we thought was going to happen in the first half of 2026. And here's what did play out, what didn't play out, and the why. Don't want to spend too much time looking backwards today, but I think it's important to understand where expectations were and what reality ended up being, and trying really more to dig into the why of those to see if there's any lessons to be learned or reflections to take forward with us. So I'm going to go ahead and just pick at random, and we're going to start with Ken. Will you start us off? I think you're muted.
Yeah, it's been interesting, right? To flip roles from an outside in to an inside out during this time period has been really interesting, right? Because you get to test a lot of the things you were talking about, kind of, as much as I hate the term, without skin in the game. So I think where we see things is it's obviously super challenging for primary freight, anything that was awarded in that last quarter of 2025, first quarter of 2026. But spot has been fertile hunting grounds, I think, for any brokerage. I think the challenge, this is a time, and again, it pulls at a lot of the cliches, is like how strong of relationships do you have with your shippers, right? If you're just a transactional broker, it's really, really difficult to go back and have conversations about the market shifting. If you have deep relationships, it could be easier. And very rarely is it one size fits all across your entire shipper portfolio. So it's been fun. It's been a challenge. I came in with an expectation to work 80 to 90% on tech. I've been working 80 to 90% on pricing the first six or so weeks. So a lot, I think, has changed since we met last.
Ken, I think you were calling for, if I remember correctly, probably close to 10% increase in rates this year, or maybe we were in the single digits. What do you think was like the primary contributor to us seeing increased above that level?
Yeah, I don't remember. You go back and roll the tape. I think it was like 15 to 20 on spot, and then 8 to 10 or 8 to 12 on contract. I think I'm going to come in obviously light on spot. It's been strange. Once these I'm curious what this panel thinks, but I think contract rates have been stubborn. Like, you haven't seen the major indices pull contract rates up yet. I think that's just a backlog of repricing efforts. I can speak personally. A lot of shippers haven't been able to mechanically reprice as fast as they want, so they've been using accessorials to offer relief on some of the more gnarly loads or higher volumes. So I think once you see this repricing effort industry-wide go into effect, I'll probably be wrong by, 500 to 700 basis points. I think we'll probably end the year probably 15 to 17, maybe 18% up on a contract perspective. I'm wrong for a living, though, so I'm kind of a bad barometer to peg here.
Aren't most of us? Okay, awesome. Well, thank you, Ken, and good to have you guys. I'm seeing some people in the comments, so thanks for being here, guys. If you're just joining or you're listening in, let us know you're here. Please add questions as we go. We'd love to have questions from the audience. David, I'm going to roll to you next and see. Let us know what surprised you. What did you get right for the first half of this year? What are your takeaways?
Yeah, well, I think January was really an interesting time. I think my perspective was really evolving at that time, especially as we got through that winter storm that dumped a lot of ice across Texas. I remember running into Chris at Food Shippers and him, slyly saying, you'll come around to me about where my forecast was at. But I took a little bit of a step on calling for, some decent inflationary conditions this year, which I think from a shape perspective, a pattern perspective, I feel pretty good about, essentially increased seasonal response, right? When you see those pinch points this year, those disruption would cause more volatility. I think we've seen that, but to a much higher degree than I was expecting. I think I had, when our forecast came out in around that time, 28% year-over-year growth in June for spot rates. Certainly we went north of that. So overall, I think it's what we were expecting to some degree, but definitely a much more elevated response from this market. And at that time, like I said, my view had been shifting. I think we started to really realize what had been happening to the carrier side of the equation and what kind of rate increases were really truly needed to support that group within this big mess we call transportation.
Awesome. Okay, I'm going to go to Jason next. And Aaron, I'm going to let you lead off our next question because I know you're going to help me out there. So I'm going to go to Jason and then to Chris.
Yeah, so I was, I think, on like the 10 to 15% up spot rate, contract rate up 5. So I was definitely, the market has shifted far more. I think what sort of surprised me was just how quick you had that inflection after the winter storms hit. It didn't come down. It worsened. And then I think May really supercharged it with the Montgomery ruling. I think, to me, the thing that sort of surprised me the most was if we look at pockets of demand, it's just been how strong the flatbed space has been. And really that, I think, is all tied to that data center physical ecosystem boom. And so I had thought as we moved into this year, I wasn't sure how much more growth we were going to see in that space. We've obviously seen tremendous growth. Frankly, given that piece, it's almost, if anything, it's almost surprising it's not tighter than it is right now. And so with that, I'll transition to Chris.
Awesome. Yeah, I think I went back to roll the videotape. I mean, last time I voted by absentee ballots. I couldn't be on, but I think I sent a chart that had spot rates peaking somewhere close to 30%, spot line haul rates peaking at 30% year by the end of the year. I think coming into early February took that to 45%, and then this month actually took that to 60%. So I think spot rates have another 30-ish% room to run. And coming into the year, that was primarily based on a supply side cycle transition, which you kind of guess based on because how I've always looked at cycles, that tends to be how these start. So even in the absence of a material demand catalyst, which there was no sign of a demand catalyst on the horizon, certainly in December, January, thought rates could clip that 30-35%. So what's the big thing that's happened since then that wasn't in anyone's forecast was certainly the Iran war and the surging pricing of diesel. I think it had spot rates peaking out somewhere close to 6 or 7% by the end of the year. I'm sorry, contract rates 6 or 7. I've since taken that to plus 15%. Ironically, I think this was in my last note. I think an interesting, unforeseen potential impact of tanking diesel could actually be a material increase in contract repricing. I think going back, the only thing that's kept a lot of these routing guides, my theory, intact has been the impact of fuel surcharges, which show up much faster in contract rates than they do spot. So if you've got surging FSCs, aligning with kind of your line haul, there hasn't been enough of an all-in premium, I think, in the spot market to cause a bunch of carriers and brokers to materially turn down more contract than they have. I think that changes. I think diesel's down like 17% so far this month, and it's going lower. So I think that's going to create an interesting, set of tension across contract routing guides, which potentially could spill more freight into the spot market, which could take spot rates up. So I think the idea of diesel rates going higher or going lower and spot rates going up is not something that I don't think was on anyone's bingo card. So I think directionally in line, order of magnitude, not even close, which tends to be the case, during these transitions.
Thanks, Chris. I don't think any of us could have even made a bingo card to fill out for this year, but we've been saying that for a couple of years now. So we all lost bingo. I'm going to move to a little bit different of an angle. Looking back at the first half of this year, Aaron, I would like your take on the broader macroeconomic conditions and obviously what surprised us. What did you see coming? What did we not see coming? And has there been, any reflections worth noting in the macroeconomy over the last 6 months?
Yeah, I think obviously kind of I'll put aside the oil shock, kind of no one saw that coming, but I want to focus on, I guess, two points. The labor market. Coming into this year, I was perhaps a little bit more bullish on the labor market than the consensus. I think that back in November, December, the consensus was that the labor market was slowing potentially substantially, that was going to kind of force kind of the Federal Reserve to act kind of to support the labor market. I think in the conversations that I've had kind of with small businesses, kind of some of the work that I've done, they came into this year kind of over uncertainty. They had kind of spent 2025 agonizing over, do we grow, do we wait, and kind of pausing decisions. And by the end of last year, they were ready to, move past that and kind of start put investments in the ground, whatever the situation may be. And I think we started to see that at the start of this year. So, we've had a string of relatively strong kind of jobs reports. I think that surprised most people. And so suddenly we're in this position mid-year where the labor market looks kind of shockingly robust. Obviously, kind of, I think the oil shock puts a wrinkle in all of that. The longer kind of prices kind of stay high, and obviously they haven't over the past 2 weeks, but the longer oil prices stay high, kind of businesses begin to put those robust plans that they had at the start of the year on hold. So I think that's still a risk. My expectation for the jobs report that we get this Thursday is that it actually comes in softer than we've seen over the past few months. We have this kind of relatively good string in March, April, and May. I think that'll come to a little bit of an end with June's numbers. The other kind of point that I would make around the macroeconomic context is inflation. So much of inflation right now, and the high numbers we've seen kind of is that pass-through of fuel costs. But even absent that, I talk about uncomfortably high but not disastrously high inflation. And that's the regime that we're in kind of right now. We had a decade from 20 2011 to 2019, where inflation ran a half percentage point below the Fed's 2% target. Suddenly, we've now had a half decade, kind of without many of us realizing it, where inflation is running kind of a half to a full percentage point above that 2% target. And I feel like that's the world we have to kind of wrap our heads around, what that means for asset pricing, for investment decisions, for cost of capital.
Awesome. Thank you. And I'm going to build on that and circle back to you, Jason, because you cover a lot about the manufacturing verticals. And so I think back in January, we hadn't seen a lot of strong signs yet. We're maybe some early leading indicators for manufacturing. We've had some positive readings in new orders and some other figures, but tell us how what that's been translating to, where that's showing up across the economy and in freight markets.
Yeah, so when you look, and especially the PMI type of measures, what you almost get is, I'd say manufacturing right now is expanding from a new order standpoint, but it's very sector specific, very akin to 2013 and 14, where back then it was a CapEx boom due to fracking, farm equipment because commodity prices were high. Right now, it's that same type of expansion, but it's very much tied to that AI physical ecosystem boom. So it's steel production for, building data centers, data center racking, massive batteries, gas turbines for power generation, electrical equipment, and things of that sort. But you have a consumer-oriented sort of durable goods side that is really struggling right now. Furniture manufacturing's down. Reuters just has another article out on how Whirlpool is struggling so much, downsizing in Iowa for refrigerators. And so what you're seeing is pockets of strength. And again, it's really tied to this AI physical ecosystem boom. But that differs from 2017 and 18, where really all sectors were expanding, or 2021, where everything was digging itself out of the hole we fell into in the pandemic. So there's been, certainly some strength, but it also, as Aaron highlighted, there's a lot of inflationary pressure there, especially on the producer side. And it's things like aluminum. It's been plastics now because of the war. That should calm itself down a little bit. But now the biggest emerging issue is memory prices, which are really going to be felt the next couple quarters when you look at a company like Micron's earnings. Absolutely.
I do want to ask, and anyone can weigh in here before we move into current market conditions. Geopolitically, I think we knew that there were risks of some things happening. Obviously, we saw a major oil shock caused by another war. We'd seen something kind of similar happen back during the Russian invasion of Ukraine. So are we, I don't want to say out of the woods in any sense, but where do we think we're sitting today when it comes to specifically oil and diesel impacts? Would anyone be able to weigh in on that and where we're at today and what could be the risk for future developments?
The thing that, if I could forecast oil, I wouldn't be sitting with you all. I'd be in the Caymans, having Claude run a Mac Mini in the background and make me millions of dollars. But I think what surprised me the most is there's still a lot of shippers that like all in rates, which I don't for the life of me understand. Especially a lot of the commodity shippers, which it's a weird intersection because you think they would know better. And when I say all in, I mean they want fuel and line haul batched together. So I think there's just going to be a lot of reshuffling that happens as, a lot of those folks do quarterly bids because they tie their retail contracts to their procurement. That's where I'm just seeing a lot of the jousting that's happening as fuel was up, and then they got some barking from suppliers, and now the fuel's coming down. It's going to be interesting to see how they time the market in regards to those type of deals.
All I would say is that the paper market for oil futures is priced in an absolute best case scenario at this point in time. So we are in the absolute best case scenario. Hormuz widely opens. There's not a large scale return to hostilities. Something crazy doesn't happen in the Russia-Ukraine situation. That to me is actually my biggest geopolitical wild card this year. Does Putin feel so much pressure that he actually considers using something like a nuclear weapon or multiple nuclear weapons against Ukraine? Because back in 2022, we were close to that from all understanding. And so to me, that's, I think, there's only upside risk for energy pricing from this moment here on out. So that's, to me, how I think about the rest of this year.
I think the only other geopolitical risk doesn't really have a lot to do with oil pricing, but the USMCA agreement that I think is due for negotiation. It sounds like tomorrow is kind of one of those deadline days. It sounds like the U.S. will likely, kind of, share their intent not to renew, but that'll keep the current agreement in place. If any changes to that deal come through or are discussed or negotiated, I think that's something worth keeping a close eye on, given where we're at in that timeline.
Yeah, great call out. One last question on the topic of fuel before we move on. I remember back during the pandemic when fuel escalated, or maybe it was the Russian invasion of Ukraine. I'm thinking about, at the time I was sitting in a position where I had to negotiate contract rates as a broker provider, also as an LTL asset provider. And in the LTL asset space, the fuel prices actually broke a lot of our existing fuel surcharge charts that we had at the time, because we had just never seen an escalation that quickly into that extent in which like our compensation couldn't keep up, for lack of a better word. And so I would have thought that we had kind of corrected anything related to fuel back several years ago. But then I was hearing from carriers, a lot of asset carriers and some brokers throughout this fuel escalation, where they were like explaining how fuel surcharges were not keeping up with expenses. And so do you guys think that we have learned anything again, and there will be more adjustments to how we handle fuel moving forward? Or are we maintaining status quo and calling this a fluke, moving on? Or is anything going to, I guess I'm asking, permanently and systematically change in how we handle fuel and transportation because of what's happened?
I wouldn't think. I think what was unique about this one is just the velocity. Right? So even if you had a relatively healthy fuel surcharge matrix, different shippers and teams will use different kind of cadences. So you may have a trailing 1 month average and going into that subsequent month where the reality is very, very different. And certainly smaller carriers and brokers were probably the most subject to the impact of that. And I think we're going to have a whipsaw on the way back down. If we get the Goldilocks scenario that Jason outlined, let's say this is the best it's going to be, and you see, oil going back to February levels and diesel quickly following suit. If you're pricing contract right now, it's tough. Because what fuel surcharge you use? Typically, you calculate your all-in rate, assume current fuel, back that out. That becomes your line haul rate if you're the provider, and then you update from there. But if you're assuming a fuel surcharge component that's going to drop by 30% between now and like the third month of that contract, and that's going to create some challenges. So I think that just that velocity, let's say there was a correction, is going to create an awful lot of volatility, I think, if stuff gets repriced because of invalid assumptions around fuel pegs and FSCs for anybody that's quoting contract right now. But I don't think we've learned. I don't see that that you see a tidal shift to something that reacts faster to the market. There's certainly the providers out there that provide that service, which are create their own challenges. So I think kind of monthly fuel surcharge programs, I don't foresee going away anytime soon.
I'll just add one last point on fuel, kind of to the extent that we see kind of this seesaw opening and closing of the Strait of Hormuz and negotiations over fees, that's just going to put a new floor on fuel kind of moving forward. So we've all experienced kind of wide swings up and wide swings down. That's kind of the nature of energy markets. Kind of maybe put like a higher cap on that downside moving forward.
Yeah, I don't, without being political at all, Aaron, I've seen commentary that says, what we've managed to accomplish with this conflict is now giving Iran the ability to control oil and dictate, and force, certain rules and requirements to be made and limiters and things of that nature that could potentially impact the cost of actually the logistics of oil supply moving forward. And so I think there's some risk in that regards too. To global supply of oil and how that pans out from a financial standpoint. Okay, let's move to, we're right around the halfway point, so we're actually doing pretty good on time. I want to shift towards spending the rest of our time talking about current conditions and future conditions of the freight markets and the economy. And so I'd like to start by just asking if someone would be willing to succinctly, state how do you believe we should interpret the current state of U.S. freight markets, and where do you see us heading in the next 3 months and 6 months? And we'll rotate through you guys and get your kind of synopsis, where we stand, where we're going. David, let's start with you.
Cool. Yeah, to kind of be brief and allow some talking points for the others, because I'm sure we're going to cover a lot of the same stuff here. But yeah, I mean, we're in disruption right now, and I think we're deeply in need of seeing, like I think Chris mentioned earlier, a reset on the contract pricing side of the equation. I think we're definitely behind. Contract routing guides are disrupted. We're seeing that in the tender rejection numbers, how consistent and persistently they've been as high as they've been. You know, when you get to these sort of, we'll call them slowdowns or stabilization periods, you're not seeing the bottom fall out on rates on the spot side of things, right? I think all these factors point to a repricing effort as we get into the third quarter. We're hearing that shippers are targeting that time frame. A lot of them are looking at a 6-month period to try and get to and bridge to the first quarter, where there is, I guess, a possibility that we're talking about more stabilization at that time. But to me, that comes down to the crux of, well, an industry that's been pretty undefeated at adding capacity when conditions get like this, be able to work against the headwinds that are the government regulations, you know, or these the Supreme Court ruling, a lot of headwinds to capacity. And so we'll see if enough is added back to help support this market, you know, once that contract pricing is reset higher.
I guess I would jump on, I mean, to kind of build on kind of the outer forecast I mentioned at the start of, taking that spot forecast up to 60%. And I think really what's behind that is, up to this point, it's been a, mostly supply side for all the forces that David outlined, driven, recovery, for lack of a better term. Demand really hasn't, contributed to the part in a material way. I think that is starting to change. So I think a case for, get into that 60% over the next, 6 months, is, 30% from here, is when I think you do start to see demand show up more. And we've seen kind of consumption holding up, industrial production is holding steady. And I guess the two primary truckload capacity demand indicators I look at, one from ATA and one from cash shipments. ATA broke inflationary for the first time since 2022 this month. Cash shipments is still year-over-year deflationary, so it would still imply that there's less volume demand on the market, but at least it's finally pointing in the right direction in terms of looking that it might break year-over-year inflationary by certainly by next quarter. So I think demand starts to show up. Relative inventory levels are starting to adjust down. I think there was a narrative early on with the overturning of the legality of the IEEPA tariffs, where we kind of created this 6-month window of consistency that everyone thought there would be a run on imports kind of coming in to get ahead of that. That didn't happen. Looks like some of that might be starting to happen now as the inventory numbers kind of tank lower. So I think we'll see some level of more constructive demand conditions. And then also something kind of David kind of mentioned, I think the supply side is much less elastic this time around. Think about how high rates got during COVID. It was plus 56% year over year. And probably the most elastic supply side market conditions you could think of in terms of drivers getting in, affordable Class 8 equipment out in the secondary market. What's happened this time is you haven't seen near the rate of Class 8 tractor orders over the downside of the cycle, because fleets and large nationals couldn't afford it. They're starting to kind of catch up now. But I suspect the amount of kind of secondary equipment ain't what it used to be. And certainly the barriers to entry for drivers will be much different than they were during the last. And so I think supply will absolutely find a way. I suspect it might take a little bit longer, which could create kind of some higher for longer inflationary market conditions in order to get the clearing rate to get new eligible compliant capacity into the market.
Chris, can I ask a question on, you said you think that supply will find a way. Do you think this is a marketplace that favors the big carriers getting bigger, or new entrants coming in, smaller owner operators and small fleets being able to start?
I think this is where Montgomery becomes interesting. So what my observation of what typically happens, when spot rates surge, especially as the spot market has gone digital, it's become much easier for smaller carriers to come in and get freight. You see this kind of decoupling of owner operators, from the nationals that, get their own MCs and go into the market and kind of go out on their own. And then when markets turn, they go back or they exit. It'll be interesting to see whether the kind of the risk tolerance or kind of the security posture from a lot of the brokers that would use these carriers, where, hey, you have to be active for longer than 30 days, or you need to have a much more aged MC to build confidence to book those carriers. It'd be interesting to see how easy it is for that dynamic to occur. You can argue either way. I mean, I think there's definitely cases for, consistency, security, where the bigs get bigger, and I think that will for sure happen. But I think you'll also see a case where, the smaller folks will find a way into it.
Okay. Jason, I'm going to come to you because I'd like for you to, of course, share your thoughts on where we're at and where we're headed, but also maybe touch on what pressures capacity could come up against trying to come in. And I'm not just talking about regulation either. I'm still talking about the inflationary impacts of equipment and maintenance and equipment availability and drivers and all of these factors too. This is a little selfish because what I've been trying to figure out and can't quite figure out is where this supply is going to come from and how fast it's going to be able to come in when we have never seen a market with this many, never seen a market since I've been here with this many headwinds pushing against us. I won't speak to anything before my time, but love your thoughts on where we're at right now, where we're headed, and then if you could also touch on supply.
Yeah, so starting with the supply piece, we will start to see capacity come online slowly, late Q4 through 2027. The supply side will respond to current pricing signals, but it's unlikely to be as pronounced as it was in the 2018 and first half of 2019 period, and certainly not as pronounced as it was in the 2020, late 2021, all through 2022 period. So you will start to see supply come online. I mean, the amount of new truck orders, even accounting for the fact we've had a regulatory certainty is now there. Even if there's some pull forward, there's too many Class 8 vehicles being ordered right now to just be replacement. There is going to be expansion, but it will be slower. It will take time. Now, where will those drivers come from? Trucking's any labor market. Folks are going to look out. They're going to see wage increases. They're going to hear folks talking about it. They're going to say, you know what? I don't feel like running a forklift. I'll go to CDL school. So the driver pool, that we've always found ways to add drivers, even back before all of the conversations about immigration and things like that. The 1990s, we added hundreds of thousands of folks into the trucking sector in a labor market that was even tighter than today on an overall basis. So we will see capacity added, but it's likely to be slow. So that would be a good good news from a rate standpoint. Where I think there's a big wild card for trucking demand in the back half of this year is what does the Federal Reserve do about interest rates? Because you have a hawkish Fed, and I would not be surprised if there's not at least one interest rate hike, if not potentially two interest rate hikes this year. And what we've seen the last several times where interest rate hikes take place is you start to see demand for trucking cool fairly quickly once that happens. We saw that in Q4 of 2018 and through Q1 of 2019. And obviously 2022, that bull market cycle ended because the Federal Reserve killed it starting in March of 22 when they started raising interest rates. And so I think the challenge is that you're not, single family housing is not coming back this year. Consumer spending on durables is not coming back in the back half of this year and whatnot. And so you have, again, this AI boom that's going to keep continuing, but then you likely have the Fed looking at hiking rates. What's difficult to say is what would 25 or 50 basis points of interest rates hike do in this conversation? But so I don't see that much opportunity for trucking demand to grow significantly. It's not going to grow like it did in 2017 or 2018. But with supply coming online slowly, I think the market's got legs to stay in carriers' favor through the rest of this year, certainly into 2027. But then the question is going to be, do we see growth in 27? And again, there's all the, potential wild cards of, if something would happen and oil shoots up to 120 or 150 a barrel, then all bets are off given where the consumer is currently at.
Aaron, I'd like to come to you and well, first of all, Jason, thank you for answering my question and thank you for your inputs. My mind just works progressively forward constantly. Aaron, I want to come to you and ask for you to also weigh in. I mean, we have a former Zillow economist sitting here. Jason just mentioned interest rates. He mentioned housing markets. Housing markets are something that the freight industry has been missing for the last couple of years. We didn't see any activity there. So I'd like your thoughts on that specifically. And then also, I wrote And I think it was in my last market report that I author about kind of a K-shaped recovery is what I feel like I'm feeling in freight right now, where we talk about the K-shaped economy and how different people are feeling things differently. And I feel like it's maybe a similar story for freight, where you can have, flatbed fleets being like, this is the best year of my life. And then we still have a lot of regional or dry van fleets not feeling what others are feeling. Maybe we have people supporting, like the infrastructure build outs, great people who had a lot of contracts in paper or durables or something like that might be feeling a different story. So where are you seeing pockets of strength in the macro economy in the next 6 months?
Yeah, I mean, this is such an important point. Kind of these aggregates kind of hide more stories than they tell, and I think it's easy to kind of to lose sight of that. But I think kind of I venture all of us agree here that kind of the recovery thus far has been driven by the supply side. Kind of there are these real debates about the trajectory for the demand side moving forward. I kind of squint out ahead to the rest of the year. I struggle to see kind of where that demand catalyst comes from. You look at kind of consumer spending. It has been resilient, but it is also still fragile. Kind of, it is narrow. It is driven, as you noted, Samantha, by kind of an upper end of consumers. Kind of the housing market has effectively been flat, if not outright down, kind of across the country. Kind of we're seeing double-digit home value declines in the Southeast. We're seeing kind of home builders kind of aggressively kind of introduce concessions and cut margins. So I think there is a lot of underlying weakness there. When we talk about interest rates, kind of Jason mentioned kind of the Fed kind of shifting toward a more hawkish stance and potentially lifting interest rates kind of later this year. It's not just kind of the short-term interest rates that the Fed controls, it's the long-term interest rates. And beyond concerns about inflation and unemployment on the near term, kind of there is this broader conversation that the Fed is having about the balance sheet of kind of debt that it accumulated over the past decade and a half, and kind of what is the path moving forward. All that to say, kind of there is this mindset shift around kind of long-term interest rates and kind of where those settle in. Ultimately, long-term interest rates are what matter most for businesses that are kind of investing in assets that have a depreciation of 10 or more years. So I think kind of we're just starting to grapple with kind of what does not just higher short-term interest rates, but more importantly higher long-term interest rates mean for kind of underlying demand. So all that to say, kind of housing kind of is in a tough spot. I think it's cyclically in a tough spot because of kind of persistently high interest rates. But longer term, it's going to face headwinds as well. You think about the demographics that have driven underlying housing demand over the past 40 years. Those are at an inflection point. Boomers are just approaching 80. Typically, people don't really begin to downsize their homes until around 83, 85. So, that supply has not entered the market, and kind of that housing supply will enter the market over the next half decade. That's just going to shift, I think, everything all of us have lived throughout our lives in the housing market.
Yeah, very interesting. Thank you. Ken, I wanted to come back to you and then maybe David weigh in on this as well. Where are we at right now, or where are we headed from a rate standpoint, as far as what conversations are happening between brokers, carriers, shippers right now, and what is that going to mean for the rest of this year? And I think specifically a question I have based on something you brought up earlier was, do you feel that shippers were hesitant this year to pull the trigger on having these conversations and these negotiations because we've seen so many pump fakes, if you will, with pricing or reasons where rates might be going up, but no, that was actually just a temporary, reason, and now we're going back down. Were we waiting to see if it was just fuel, and we didn't want to go adjust routing guides to then have the market settle back down and we're overpaying? Do you think there was some hesitation after years of a low market point to move quickly, and that's why we're allowing these higher tender rate rejections to go on and to continue before contracts reset? I think that's really what I want to understand is what's the attitude around this rate increase?
I think the dams have busted open. I mean, I think any of the last holdouts, and as much as it pains me to say, like I think the people who were holding out I think you could have made a case during road check week that it was just road check week. I think everyone got clobbered the week after. Frankly, if you're at a major shipper and you're still holding out, you're either packing a box or you're going to be packing a box. I mean, this feels like if anyone was in the industry, I think it was 2018 when General Mills, it's just burned in my brain. General Mills had to restate earnings based on supply chain overruns. And you just saw like a massive catharsis around the shipper community of procurement people popping up on LinkedIn at news spots. I mean, it was just a wholesale clearing. And I really don't know what went into it. I mean, it has been a lumpy first half of the year. I mean, they're like rates did come back down after Fern, and you were starting to see some of those things of kind of the market going back. And I think like Montgomery was probably a watershed, but also it's like going to a swim meet and like taking a hot take that the swimmers are going to get wet. Like rates were going to go up this year. I don't think anyone on your panel came on here and projected that rates were going to be down. I don't think any sane person was projecting, like the cycle was going to, we kind of knew in the fourth quarter of last year, the cycle was going to turn. I don't think anyone expected it to be this extreme. I will say like you got a lot of well-reasoned takes here. I think as we look to the second half, the conversations with shippers, I don't think anyone believes that there's a lot of empty calories amongst the DOT and FMCSA right now. A lot of like multi-camera shots of people talking about immigration. I think like an apolitical statement, the Republicans are going to get absolutely annihilated at midterms this year. Like it's going to be an absolute barren wasteland, probably in both sides of the House and Senate. So what usually happens in a lame duck 2 years, you see a lot of turnover. You see a lot of preferred placement amongst cabinet roles. I have to imagine the reality show with Duffy is like already in the can for the first season. So I don't, going back to what Pickett and a couple others said, I just don't see a world where we don't have capacity rebound back to match these rates. I don't think that the Burt Reynolds era of trucking is coming back. I just don't. I think we'll get to autonomous before we get back to a point where you have kind of a wholesale replacement of all foreign truck drivers with domestic-born truck drivers. I just don't see that world happening. So supply meets demand. It's probably a rough peak. We'll have that lull after the 4th of July. And then probably sometime in the tail half of 27, we go over the crest and brokers can breathe again. That's probably my mild to warm take.
Nothing to build it, man. I think it's now that fuel is starting to come back, only now I think are a lot of spot market carriers actually finally able to get and stay profitable. Like you think, with these surging, spot rates, if you look at the rate of diesel increases, came right kind of behind it and kind of ate up all that surplus op income that, these carriers have otherwise made. So it's almost you need to, if assuming the Strait stays open and Goldilocks scenario is here and oil stays low and, diesel goes back to kind of February levels, I think you see that op income line start to expand and the spot market start to look a lot more profitable. The supply side will find a way, and then the market will find wherever that clearing rate needs to be to attract, necessary labor to resolve the equilibrium and set the turn. The market will find it.
Yeah, I think it's a great point, Chris. I think the one thing that we do, and we're all guilty of it, I think, some more than others, is like we take the one tweet of the produce hauler in Arizona that has a $15,000 ripper going to the Northeast and extrapolate that to the market. We ran the tremendous study. As I was leaving DAT, the convoy team ran this study as fuel was spiking. And something like 18% of fleets that responded were actively parking trucks at the time. And again, it's a stack rank. You park your oldest equipment in some of the areas that may not be the most lucrative. So like fuel is a very real cost advantage, and that just some of those kind of flashy spot market lanes weren't enough, I think, to assuage the real hit that some of these carriers were taking.
I think, and I would just say not even just spot, but in contract as well, because when we see fuel changing so rapidly week to week, especially in different parts of the country, the folks who run the model where we get the release of what fuel was on Friday and then we like run that for the next week. I had carriers with over 100 trucks, coming to me saying we're losing tens of thousands of dollars every week right now on fuel on our contract lanes because we're running heavy lanes out of California and they're not updating them for a week. And then they're just telling us to wait for next week. And they didn't get that money recouped, right? Like they were always lagging that. And so there was carriers running contract lanes burning $50,000 in fuel every week that ate up the margins that were there of if you did manage any type of contract rate reset, which they likely did not. So there's also that narrative where you have to understand, where was the carrier at? What type of lanes were they exposed to? Where were they pumping their fuel? And a lot of this was disadvantageous even for the fleets.
I don't know a lot about many things, but I will tell you that sales reps at Breakthrough Fuel had a record quarter. Let me tell you, like I would take that.
I would be lying if I would said I hadn't thought that already.
Yeah, I think like I would take that. You're going to see a lot of expenditures coming out of those sales folks.
Yeah, David, I wanted to come back to you and just kind of get your additional thoughts too on everything we just kind of discussed as far as what's happening with pricing right now and the attitude of shippers as we're going through the rest of this year. And I also think a specific question for you, if you can answer this one for me, are we going to find a new floor for rates that will just become the new normal? Because like Chris said, we're going to get to a point where it's attractive enough. We're going to have the supply come in. If they build it, they will come. Sure. If they come in, what I'm hearing is we're going to have to attract them in. And we have a lot of fleets wanting to grow right now, a lot of fleets with the means to try to grow, but they need drivers. And so we start looking at driver bonuses. We start looking at driver pay increasing again. And so we cannot go and increase labor cost and then not increase the rates for the lanes that they'll be running, would be my thought. So do you think that just the actual effort that goes into attracting this next wave of supply is going to systematically reset rates to a higher baseline?
Yeah, I mean, a lot in those questions. I mean, we can talk about that all day here. But I think just starting with the shipper point of view, certainly we've seen a shift in mindset for sure as the year has gone on, to kind of echo what Ken said. But how can you blame them, right? To some degree, every single time we've seen rates increase, there's been a catalyst, right? Whether that was Fern, or with Iran driving up oil prices, or even as we gotten into the summer peak, right? Seasonal demand, road check week, et cetera, irregular shipping patterns. I mean, once we got past those disruptions, I think that pattern matters, right? The annual seasonal cycle is really important because I think the rate trends have followed that pretty closely. We're in a vulnerable state right now. And I think we're going to continue to see large scale spot rate swings when we see disruption until we see those contract rates reset and alleviate pressure in the spot market. So to me, the first sign that we're going to see any kind of long-term stability with rates is going to come from declines in the tender acceptance or tender rejection rates, right? You need to see contract routing guides reset to the point where you're seeing in mass improved primary tender acceptance. That's going to limit that demand in the spot market that creates the opportunity for these rates to continue to cycle up. So I think it's really important to watch and see what we see from a contract reset perspective in the third and fourth quarter here. I think that is going to be an important catalyst if we begin to enable and facilitate tender rejections to come down, which is possible. What seasonal disruptions do we see between July 4th and Thanksgiving? It's pretty limited in what's expected every year, maybe a little bit around Labor Day or an end of quarter. But that's a pretty long period of stability we could be entering here, right? And it gives a large opportunity for current rate environment to be considered, the new floor for contract pricing. So I do believe that this is a critical point. I still think it comes down to, in terms of the duration here, how long it's going to take to get capacity or supply on the road to help meet that demand, especially if we see demand growth. But we're going to stay inflationary in my mind until we get to the big pop of May of next year, at the very least, just from how much higher rates are now than they were even just 60 days ago. It's going to be hard to be back below negative year over year until we're back to May, June next year at the earliest.
Fantastic. Thank you. All right, everyone. I want to go kind of, let's think rapid fire around our circle. And I would like for you guys all to give just maybe 2 minutes of your closing thoughts, predictions that we can come back to in 6 months and say, how did that statement hold up? And then also any advice that you might have. And you can choose who that advice is for. If you feel more comfortable speaking to a broker audience, to a carrier audience, to a shipper audience, give advice to your respective audience there. So we'll start at the top and we'll go around. And Chris, I'm going to come to you first.
Yeah, I mean, I think the cyclical recovery is afoot. I think there's been a ton of stuff to kind of mask, I think, what's been going, everything from weather to Supreme Court rulings to surging in diesel. But I think what is setting the tone for what's happening now in the spot market is, sufficient supply finally exited over 2024 and 2025 to once again, shift the market into one of supply scarcity. So I think ironically, my sense, the thing that prolonged the freight recession for as long as it went in terms of how deep and for how long, I think is the same effect of what's getting rapidly unwound now in terms of rapid exodus of what are now deemed non-compliant drivers for whatever reason, compounding with rising diesel. So I say that to say, I don't think rates are coming back materially anytime soon, even if there's zero material demand catalyst. Whether the spot market tops out at 60% or 50% or 40%, it really doesn't matter. I think contract rates will be resetting higher. This is the natural order of things. It won't be forever. Eventually the market will find a point where capacity comes back. I think, watch out for just that unforeseen impact of surging diesel, putting more pressure on routing guides, spilling more freight into the spot market, which could drive up overall spot rates, which would be pretty counterintuitive. And I think overall, supply side inelasticity in this next cyclical response to it. But at the end of the day, this too shall pass. It always does. I think the shippers that have had long-term supply partnerships, that will continue to work. It's not like every carrier is going 0% primary tender acceptance and trying their luck in the spot market. That typically isn't how it works. I think the shippers that didn't go out and rapidly reprice all their contract into a falling spot market will do better than the ones that didn't. And at the end of the day, long-term, I think supply partnerships will win the day. I think, technology is more and more important to folks that are invested, not necessarily in AI for process optimization, but just visibility, understanding how your routing guide is holding up. It's really hard to do anything about it if you don't know what's happening to you in terms of how active are your primary contract carriers? Are they taking the primary? Which ones aren't? How do you drive faster conversations to course correct as we go? So I think the carriers that won, shippers carriers that have the long-term relationships in place and have the capability in terms of the talent and the technology to move quickly will be just fine.
Okay, thank you. Ken?
Yeah, I would caution folks to be jumpy. I've seen this story a few times. I think it's going to be a busy tail half of this week, and then it always slows down. It's always slows down. And I think you got a little bit of fool's gold that's going to happen where people are going to start saying that was a flash in the pan, blah, 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 blah. We don't have a clean picture of capacity at the moment, given the modus cut over and all of that stuff. So I think between the 4th and Labor Day, it'll be a little bit of a mirage. I do expect peak to be bumpy. We're having conversations with all of our shippers, kind of setting up PTA strategies, getting things locked, using this as a test bed for that. And they've really appreciated that, kind of taking this out for a walk before we get into the throes of peak. Mm-hmm. But the advice I would give is just come in every day and optimize. I've really appreciated getting back on the side how much brokers are willing to share with each other. It's very unique because it doesn't happen amongst SaaS companies. I remember when you'd be at DAT and Craig Fuller would post something and it'd be like the SpongeBob meme or The Office where things are just going nuts. Whereas with here, it's like I'm learning a ton from people who are posting things on social or conversations that I'm having. So I think it's just be open to changing your strategies on a more frequent basis and not get pigeonholed into one position that could burn you. It's something I've learned. I've had to relearn very rapidly in the last 6 weeks.
That's great advice. Thank you. All right, Jason.
So I'm agreeing with folks. The rest of this year, you're going to see rates remain high, really regardless of anything happening. You're not going to see much capacity come in the back half of this year. You'll see more start to enter in 27. I think the big thing I just have everybody take away is you have to be planning for different scenarios right now. One case where, hey, oil stays around 70 a barrel. What does that look like for diesel? And we're not seeing diesel futures come down quite as much yet. So that's the other thing. Be following diesel futures, gasoline futures, et cetera, because that's what the consumer or end user is actually going to be paying. Mm-hmm. But you've got a budget for that. You've got a budget for a $90, $95 scenario, and you should budget for a 120 plus scenario. So you take that playbook. And again, the other thing I tell folks to watch for really kind of as a macroeconomist is watch every statement about AI CapEx and what starts happening in that space. Because if you would see any of the hyperscalers say, maybe we're not going to pour $300 billion this year into, physical infrastructure, that would be the type of catalyst that would start to slow that additional growth of that space. And until we have single family housing and consumer spending on durables pick up, that would be a headwind on freight demand. So I think right now, given sort of the macro trends in the economy, doesn't matter if you're a broker, shipper, or carrier, you need to be following what in the world the hyperscalers and everybody else is doing on the AI CapEx space, because that is really the engine driving a lot of U.S. economic growth at the moment.
Well put. Thank you. Aaron?
Yeah, I mean, I think obviously echo everything folks have said before. We know that the cycle is driven by this cat and mouse game between supply and demand. Sometimes I characterize it as a rat and cat rather than cat and mouse, just because it's not clear who's chasing whom. But kind of looking out over the next kind of 5 to 6 months, I think you have to be worried about underlying kind of demand in our economy. Kind of your base case has to be that kind of consumers are fragile. They're going to be a little bit conservative given the shocks that they've experienced over the past few months. I don't think kind of that's everyone's base case, and I think kind of retailers and wholesalers are planning for that base case. So if there's a surprise, it's not going to be a surprise to the downside. It's going to be a surprise to the upside, that interest rates kind of come down for some reason, that kind of there's kind of any sort of catalyst that shocks kind of the consumer to the upside. So I think the base case, the consensus scenario for consumer demand is flat to down. A surprise that would kind of ripple through kind of freight markets would be an upside surprise.
Interesting. Thank you. David, I just kind of made you share a recap not long ago, but any advice and final thoughts for us today?
No, I mean, look, we have probably the group of the smartest people in the industry here, and there's still a ton of uncertainty, right? And I think from that perspective, flexibility should be the mindset, right? I know that's definitely been a voice of a reason here from this group too, but shrinking your network right now, okay, that's been a strategy, maybe not the best strategy right now. I think continuing to keep your options open, know who you're working with from a safety and liability standpoint, manage your risk and be flexible. Those are the best things I could tell to a shipper right now. If you can shorten your term to reasonable timelines and you have flexibility in your budget, continue to give yourself the opportunity to maximize that partnership that you have with your carriers, whether that's asset or broker. Give yourself that opportunity to not be locked into the high for too long or the low for too long, or to be able to capture downswing when this thing does start to turn down. So I think flexibility and risk management are the key thoughts right now, your swing thoughts as a shipper.
Awesome. Anybody else have anything they would like to add before we close this up? This is your speak now or forever hold your peace. Okay. Fantastic. Well, thank you all so much for joining me again today. All of these gentlemen are active on LinkedIn. So if you're listening in and you see a face or a name you don't recognize, I just realized we forgot to put names on our screens today. Whoops. Please find these gentlemen on LinkedIn. Their names are in the episode description. I believe I even tagged them. So they're easily findable. There we go. We have names. Fabulous. And thanks, guys, for listening. Please connect with them. Follow their work. If you guys have questions, if you're listening later, this goes to every podcast platform. We have listeners on a lot of them. You can always come back, find us on LinkedIn, tag us, ask a question. If you're listening back later today, tag the person you have a question for in the comments. Let us hear it. Send us a message. Let us hear the questions. Happy to have those conversations. Also, if you are a shipper or a carrier or someone needing to procure economic advice, all of these gentlemen would be fabulous to reach out to. And they are excellent contributors to our space, run excellent businesses, and can't recommend them enough. So please connect. All right. That's all we have for today. Until next time, thank you, everyone, for meeting us for coffee today.